Good morning, everybody. Happy Monday. Welcome back, 2026. First official kind of trading week for the year. Um, let's get started. Hopefully, we are back into a little bit more normal volume, a little bit more normal market efficiency, either this week or next week. We do have some data this week. We'll take a look at that. Let's assess everything today. Markets are up a little bit this morning. Here is a look at futures. We are showing, here's MicroStrategy up 163. Bitcoin, I saw an alert at 92.5, which is kind of a big deal. Up to 92.7 right now. Chart alarms are set 94,700 all the way up to 100K. This could be an interesting look for 2026 to have Bitcoin come back alive and well. Futures market this morning up 0.41%. So pretty decent pop to the upside. Let's see where the SPY is going to be at this morning, up about $2 and change. Let's take a look at some gamma this morning as well. Positive gamma above 68.55. Sticky levels 68.90, 6900. Well, I'd love to see that move to the upside, obviously. We will see. So if price gets to 6,900 today, my break even on my engineered options. I posted this last week. This was just kind of the teaser. We're doing this officially next week. We launch this service. This will be a weekly and monthly service. I've got it also engineered down to dailies, all the way out to quarterlies, but I'm going to focus primarily on weeklies and monthlies. And the trade that I took last week, right here, 6,900 by 68.95. And also the 68, 50, and 45. So both of these filled last week for 250 credit. If we can get price, even on this one into today, if we can get up to even a partial loss, if I take a partial loss here, but take a full win, net profit on the week, that would be the goal. And obviously, if it's above 6,900 with a decent push this morning, then I'll take, even if I manage this one with a small winner versus the full 250, take a full winner here. That's obviously a good trade. So anyway, more to come on that. We'll start doing official launches on engineered options, I think this coming Sunday. So you'll probably see some emails or some messages coming through my Telegram. So keep an eye on that. And off we go. Get the chat up for everybody. All right, and give me one moment, please. All right, those holiday sniffles have lingered into just a stuffy nose, but it's been around for the last week. All right, futures up 0.4%. Looking at a little bit higher gap this morning. Gamma positive above 68.55, possibly a directional run into 6,900 or close to it today. The bonus trades that I did with that broken wing butterfly, I did not get filled. I did not get filled at the what was it, the 55 zone. It didn't fill me at $2. So I didn't get that trade. If we come, I mean, I closed out the trade for that partial loss. I'm just taking that partial loss. I will look and see maybe for this particular week, as long as price can kind of finish the week positive. So we're, this is last week's close. If we work our way higher, I mean, even having this as like our break-even point, or having this low last week as our break-even point, we'll see where we go. I mean, is this it? Like this little dip, this little holiday struggle over a couple days, and we right back up to all-time highs. Again, I have my reservations about what that looks like technically, because just this little poke above all-time highs. I just think we have at least some sideways chop we have to deal with this year. Okay. So we'll keep an eye on that. Let's do a little top down. Let me go some currency strength. Let's look out, refresh this. Should be seeing some positive flows this morning. 0DT positive. Anything above 84, gapping higher. So 68.90, 6900, 6905 looking pretty good this morning. So there's my 68.55. We'll be gapping higher. Two levels to watch today. Pretty easy read. 68.90 and 6900. So above 55 is positive gamma. We're gapping higher. Previous highs here. Maybe a quick butterfly spread into this area wouldn't be bad for a small but reasonable winner. Low risk. And then for daily profit play, let's see what our plus minus is on the morning. So let me log back into Tasty here. All right. So for the fifth, we're looking at a plus minus 30 points today. That accidental trade, that happy little accident that I took last week for daily profit play, $1.05 closed out at 70 cents. Grabbed a little winner. We were still selling. I mean, it actually looks pretty good for a bigger chunk of profit this morning. 69.30 being the upside, 68.10. We're gapping higher this morning. So I'm curious what this trade looks like this morning. If you were holding over the weekend, I didn't hold it. So I grabbed that 35-cent winner just because it was not the actual expiration that I wanted. But that trade's looking pretty good just using the deltas that we did. Plus minus 30. Just going to write this down. So Monday, plus minus 30.03. Okay, let's get some market efficiency in here today. We'll be gapping higher. This will all shift in the next 15 minutes or so. And if we gap up to, let's go 0.4%. Yep, 0.42. So we gap up 0.42. That's a pretty decent push right into those top gamma levels. So 68.87, do a plus minus 30 from there. So possibly right back into, the high side like 69.17. Low side would be filling the gap. So, seems like 69.20 could be a reasonable like resistance zone today. Gap fill around 68.60, 68.55 just for today's price action. As far as the VIX goes, VIX is retreating a little bit. If we come back and fill the gap, we should be seeing upside price action. Recent VIX high is right here around 1528. So I'm going to use that as my high low on the day. 0.95, 0.96. So this is the trade that I took last week. We'll be kind of pushed. If we're gapping up today, we're pushing right back here. Interesting how it's like the put side was kind of threatened and then came back, allowed me to get some profit over the end of the day Friday, and pushing up into maybe 68.85, 68.87 for the open this morning. It's kind of right back into the middle. If that $1.05 is going to be worth a little bit more, but I'm going to clear these lines. we'll change the VIX calculation. So if we're gapping higher, let's go delete. All right. So we're looking at a 0.96 based on the VIX calculation today. We're gapping up by about 0.4%. So we'll take this kind of gap open and then go up zero point 0.4, or I'm sorry, 0.96. So we gap up. I need to go 0.4 here and then up 0.96. So high of the day should be 69.50, 69.55. And that VIX is at, we're taking this recent high this morning around 1527. So move this down to that level in case the VIX cracks above it. 1528, 1527. Okay, I'll recenter the indicator. And then from the close last week, 0.96, 67.92. All right, 68.58 reset. There we go. Okay, so watching, see where things are going. Gap higher this morning. Gold and silver will take a look. Larry, did you have you did a 10 wide on Friday, right? Yeah, it was pushing down all day. I mean, here was the open Friday and market settled around 16 points. I mean, I think we only had like a 20 or 21 on the day, but it was down as much as, I mean, almost 50 points from the open. Actually, even a little bit more. I mean, yeah, price was down 54 points from like a plus minus 20. So, yeah, well, I mean, it was nice to see that the market came back and closed within that plus or minus move. Okay, yeah, yeah. So I was pushing that 40 side the whole day, man. Good. I'm glad it came back for you. Okay, so those are some levels that we're watching. Let's do a little top down here. Gold getting some love this morning. Silver, same thing here. Keep an eye on it. I do have a measure move on gold or on silver between 91 and, I mean, obviously 100 is a big fat round number to go after, but between like 91 to 96 is my symmetry area. 100 would be just a gravitating move towards a round number. Um, I don't know if this is going to be like a uglier, noisier, more volatile window, but I've heard an interesting segment from, I think it was something from Fidelity. I don't know if it was like financial advisors or just across the board with like the accounts that did the best last year, and Fidelity's information for traders that did the best last year as far as like their average retail trader, um, those that forgot their password and those that passed away, which is, I mean, it's obviously kind of sad, but the reality is 2025, even though it was an up year, it's how we got there. I mean, I said this back in April when, we had that big dip and we had the rally started. I was like, if we get back to all-time highs, this might be one of the dumbest corrections that I've ever seen in the market. COVID at least had, a global reason for it. It's like April 2025 had no reason for it. Like it was, I mean, I heard a lot of people call it the snow globe effect, which was Trump, Trump and company just kind of shook things up and basically pivoted hard. I mean, we had administration that was hired on uh, saving government money, rooting out or kind of smoking out some of this fraud that is still happening. I mean, I don't know. There's stuff going on in Minnesota that keeps making news. Doesn't matter. Point is, it was a pretty hated rally, but then the market latched onto the AI narrative and ended up finishing the year 16% positive. Everyone's super stoked that, oh, the Nasdaq was up 20%, S&P up 16%, but the U.S. got lapped globally. There are a lot of countries up 30+% last year. Some countries individually up over 50% last year. Does that mean I just automatically want to park money, into other countries? No, but I do think having some non-US exposure would be pretty good for 2026. AI narrative is important. I think that if we get a correction first, that's probably an easier thing to trade versus going higher, 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 higher. These valuations are, historically speaking, they are going to put, it would be like carrying a bucket of cement with us to expect all this growth, and at these valuations, it would be, I think something's going to slow us down. Or like, if you're um, ever like dragging a heavy child on your leg and they won't let go, like that's kind of what I think the U.S. markets are at valuation wise right now. So doesn't mean we can't have a positive year, but I think there has to be some type of compression. I do have a chart. I think this is an interesting chart. Got a few minutes for the open. Um, this just put a kind of a probability cone, and let's go to SPX at these valuations. Let's see. There it is. All right, let me see if I can send this to myself. Okay, let's do this attachment. This one. Okay. So this is a pretty good one. Yeah, a lot of the stuff going on in gold and silver, it is China. It is Asia, it is China. Doesn't mean it can't get pumped up higher. Um, your silver bulls, your gold bulls. I think inevitably the story is going to be about gold. I really do. Um, Look, I'm not buying gold and silver with leverage. Okay. I think there is a run to, hoard physical gold and silver at this stage. Um, there's going to be a lot of volatility ahead. I don't know if the volatility is going to be, crazy parabolic moves higher followed by aggressive crashes. If it's going to be, I'm still technically expecting gold to find this 200-day moving average right here. Now, whatever that looks like, going forward, it might be choppy. It might look like it's consolidating more. It might just continue to ride this thing higher, right? But just be aware that there will be a lot of volatility. This is going to be much harder to trade than an index, right? I mean, if this thing is going to go up 100% for a year, that probably means we're dealing with 40 to 50 to 70% corrections. Okay. So just be careful on going all in. I think that an allocation is great. I think if we get pullbacks, I mean, even if price is running higher, set pullback percentages and just change them. Right. This is what I'm doing. I have all these moving averages looking to buy some dips and just throw another couple $1,000s at each level. Not knowing if that's going to be like the bottom, but I would imagine that there's pretty good structure in here. Same thing for silver, probably structure around $50 is going to be a good support zone, right? But if we're up higher, it's like, okay, what's a 10% correction? What's a 20% correction? What's a 30% correction? Keep those levels handy. Same thing on silver, which had a crazy year last year, trading at 76, previous highs here 84. If we have any pullbacks, from this high, it's like we had a 15% correction in one day. So I mean, I the last dip I bought was right in here. I closed out a 3-year position near that top. I have participated a little bit. Like the entire way this has been running up, I have had exposure, but it's probably a tenth of the size of what I had going into this year that I felt like I was pretty proud of myself for riding it as long as I did and up to this recent high. Gold was much closer to the recent all-time highs, but I'm still in both. Point is, do we hit these moving averages? I hope so. Previous all-time highs around $50. Does it become support? I hope so. But there's an argument that, we've had the margin raised, I think, by 35 or 45% on silver futures. So it's going to shake out some of the loose hands and it's going to go right into the deepest pockets with no leverage. So, I mean, I just read this weekend that JP Morgan and Citigroup are like accepting physical delivery of silver. They're claiming that it's not them. They're claiming that it's for clients, and it's some other mandate. But I think it's big U.S. banks that are playing the silver hoarding game right now. Gold's always been a thing, but it's just becoming more and more popular. Also, the difference between the two. Okay, we're trading down to 57 on the gold silver ratio. If this gets down to 40, and I will watch this for the year, if this gets down into 40, historically, it's always been better to trade gold. Okay. So our historical average is around 50 to 60. So it's kind of coming back into that norm. But if we get down to 40, gold is typically an outperformer when it comes to that ratio. So if you're looking to kind of rotate with like crazy aggressive silver profits, take some of those silver profits, put it into gold. So anyway, it's going to be an interesting year for 2026 with silver and gold because it had such a headline grabbing 2025. I'm not the type of I'm not the chaser of direction. Like I get it that is ran and it makes it really exciting. Doesn't mean we can't have crazy volatility and pullbacks. And it's like I want to buy more. I get it. Like I want to buy more, but I don't like seeing a chart that goes parabolic to the upside and I'm excited to buy that high. It just doesn't interest me that much when I think technically we should have a pullback to the 200-day moving average this year on gold. Silver probably follows with some high volatility because of the gains it had last year. You just don't see charts that typically look like this that don't come with crazy ups, crazy downs. So just be prepared for that. But that's why I'd hope that it's just a percentage of your account versus I'm all in on gold and silver and it's 90% of my account is all in gold and silver. Just that would be a wild roller coaster ride of emotions, I think. Okay, David says for those that own gold and silver coins, would be nice to learn the best way to protect those positions. Yeah, we talked about that last week with looking at some butterfly spreads, right? So just I mean, here's the deal: if you have physical gold and silver, um, the futures market was created to hedge. So I mean, if you're trading GC or SI or even the MCG, which is micro, or I think S is it M? What's micro silver? Um, okay, so SIL is micro silver futures. So on paper, like these are decent ways to hedge. SLV you can also hedge, right? And it would be nothing more than I don't know. I mean, and honestly, it's like if you own the physical side, I mean, you sell it. If you're really wanting to protect your profits, it's like then you sell it. Um, the one company I've been following the last few years is Miles Franklin. That's they if you want to sell silver and exchange it to gold, you want to sell gold, exchange it to silver. If you want to buy at spot price, I think they were doing some specials where they were allowing users to buy like $1, 30 under spot price. I don't know if that's still available. Um, anyway, there's a whole different game of like the physical side of gold and silver and the trading side of gold and silver. Um, but I mean, I guess doing nothing seems honestly, it seems fine. If you give this time, it's like probably the values will go up. I wouldn't be surprised. So, all right, we have. They also store it for you. Yeah, Miles Franklin can store it for you. Um, anyway, there's things to look into as far as like preserving the capital. But I have no idea where people are at from the run that we see in gold and silver. What I do think has come into it is like some crazy wealth with some asset that I mean has no intention going up 100+%, and it did that in both last year. Um, that does sow a little bit of distrust into the U.S. Fiat system, and I think that's what the headlines are kind of grabbing onto is this is the debasement trade. This is the start of everything, and we're going to go back to the gold standard. It's like we might, but none of that's a guarantee. And the U.S. is never going to do this stuff without going down without a fight. So the U.S. doesn't want to give up the reserve status of the dollar, right? And I think if anything, the U.S. can preserve would be like we have the kind of the liquidity side of the dollar in the fiat system, but we have the like the savings account that is gold or silver, um, and hoarding that, but also, hang on a second. I think I might be looking at some profit today. That was a quick run to 6,900, huh? Okay. So to that max 250, I'm up 210 this morning. I need price to stay above 50. Probably can. I'm gonna go ahead and just grab some of that profit this morning. So that's 250 trading for like 40 cents, maybe less. So I get us for 30 cents. I don't know if we're coming back to 50 today. I'll replace this. I'll go down to 10 cents this morning. All right, let's have a look. So we got some big gaps this morning. It's go time. We came right up into our gamma plus minus 30 on the morning. VIX is down a little bit. Make sure we're not going too much higher. Let's go here. Make sure I have the right expiration for the 5th. We do. All right. 69.30. Waiting for that first little pop there. So 30 downside. Let's look at a 45. All right, I'm gonna see if this trade fills for a buck. Oh, I'll put it. Head gummit. All right, putting in $1 on this one. So I got filled for. Let's see, what's the difference if I put in. Try to get this running for two contracts. If I do 70 cents plus $1.30. All right. So I'm going to put in a second contract. That was stupid. So the trade that I want to put in is pending for $1. I got the trade in for 70 cents. What I'm going to do now is put this in for $2 and have two contracts running with a break even of $1. Okay. So if I get filled at 70 cents, get the other one filled at $2. I guess $1.30. $1.30 and 70 divided by two. I have a break even of a buck. I'll put that in for, let's go $1.50, I guess. $1.50 credit. All right. The trade I want to take for daily profit play is a 30 and 35 and 45 and 40. So it's coming out for daily profit play members right now. Today's the 5th. Okay. Sean says my SPX closed 90 cents debit. Is that the bonus trade there, Sean? Okay, nice. Yep. So let's see if this fills for a dollar. Um, I'll keep an eye on this one. So filled, working. Where is my? All right. So 30 by 35, 45 by 40. I'm doing a lower delta here. So these are around the 10 delta levels. See a price for Monday kind of comes back into market efficiency. Hopefully it does. Even if I grab a full 70 cents out of the day, that's fine. Or as much of this, if I close this for like a 20-cent debit, I'd be pretty happy with that. I'm going to keep an eye on price, get a couple defense trades in. VIX high, we use the 1528. Here is my calculated kind of top area 69, 50, 55. So let's see what this looks like for today. 50, 55 if I buy, sell, buy. This would be my defense trade. So I'm gonna try to get that one filled for 50 cents or a dollar. It's a dollar credit. Make sure I'm going after a dollar credit. Okay. And then to the downside with a gap around 90. That was a 67.90. So I'm going to go 68, 67.90 to give me a 10 wide trap. And there. That was my break even around 80. Try to get filled for a buck on that one. Okay. So those are defense trades. They're probably not going to fill. It's all about kind of this position here. So for the week, all right, I'll get my levels. We're right at the top of our gamma already. So really the gap up got us up to a 100% ATR. Price would probably struggle to go, dramatically higher. I could see us getting up to like maybe 69.10, 69.20 today. But that's still within a market maker move. We opened up around 91. We had a plus minus 30 on the day. So that, high side of like 20 is probably pretty realistic. All right. And let's see what 6,900. Okay. So I'm going to get a break even on my engineered options of about 25 cents. I'm going to take hopefully a full win on this trade here. So this one, the plan for this week, these trades are already executed last week. This one, I'm going to take a partial win. So closing this for like a 20 to 30 cent debit. Or actually, no, sorry, it's going to be a winner. So it's going to be like a 220 to 225 debit. Just type it. So closing at 0.20 to 0.30 profit. 220 to 230 debit for a small win. And then down here, looking for full win or closing for like a 20 to 30 cent debit for larger winner. Okay. This is a service that I'll be running. We're officially launching this next week. So I'll get the tease on this a little bit more this week and today with Lance and the team at 1 p.m. Okay. Catherine, you're still in the bonus trade. Bonus trade at 68.98. Okay. So bonus trade, we talked about it last week. I did take that partial loss. Here is the bonus trade. Where are we at? So the 15.05 and 68.90. That was the bonus trade. So 15, these are all puts. So it was 69.15. That was a buy, sell, buy. Are we in bonus like who's seeing the trade right now? We put this trade in, we got filled for $2 credit, and right now it's showing, 20 to 25. It's like, what are you closing this trade out? I would not let this thing sit all day. If you've got profit on that bonus trade, I would close it for profit. So what's it trading for right now? I'm showing a 40 to 60 cent credit. Okay. But that tells me that we're probably seeing like if you took the trade in for $2 credit initially with me last week, it's probably showing like a 20, 40, 60 cent debit to close it. Again, take the winner. I wouldn't try to sit and get cute on this profit trap today. I would just take the profit and move on. Okay. So if you can close it for like a 20, 30 cent debit, you're grabbing a dollar 60, $70 out of the trade. That's a great win. Take the winner. So if I was still in the trade, I'd take the winner. Don't try to be cute with that profit trap at the end of the day, just in case, because it gets slippery. Look, if this market can't hang to 6,900 and it slips below 6,890, you're taking a full loss. So the goal was to see a price could linger around 6,900. It's there today, but I don't know. Just if you got 160, $170, it's a good win. Take it. Okay. If you want to hang on to it, you're trying to play the game of the profit trap, which is you have no risk to the upside. You have your profit trap, and then below 68.90, you have your risk. So it's right in the sweet spot right now, which is nice. But the profit trap pays in like the perfect profit trap is at the end of the day, and it'd be around 6,900, 6,905. That would be up to a $500 to $1,000 profit trap, which is awesome, but you need price to cling to these current levels. Okay. All right. Yep. So really quickly here, um, we put in. So the 6,900. Let's see here. My level zero trade closing for winner. Level one trade closing for winner. Usually, I like to let these trades run to today's expiration. But since the market is making a nice comeback to the line in the sand, okay. So booking a couple winners there. Let's see, last week was the what? 29th. Okay. Just give me a second here. That's been updated. We're good on that. Officially next week, that'll start, Daniel. Yep. So all those trades will be official. Like service officially runs next week. Lance and I are launching it officially on Sunday. Um, like pre-market Monday, levels are in place. Like placing orders, set it and forget it. It's good for a week, and I'm running a weekly and monthly service around it. So I'll be teaching some classes on it. We'll get right into the core strategy for the first week that we have the launch, and I'm looking forward to it. Honestly, like it keeps it keeps like the income side of things like flowing pretty smoothly. I think at the end of the day, this year is still going to be surprisingly solid, despite the. I mean, I don't have patience, but I think to me the big difference is like we do have plenty of tailwinds. So let's say that the market, like look at the macro stuff right here. Get rid of this. Is this my? There we go. So my macro, this is back to like a 3-star bullish trade this week. So we have everything from the 1 hour, 4 hour daily looking pretty solid, right? So stacked up bullish, bullish, bullish. That's a good sign. Do a quick update here. So it was indecision as of Friday's close. Now it's back to bullish because of the gap. So I'll start looking at my key levels and start looking at my trades for a 112 expiration. But I can have these levels set up like Mondays. If we have a gap up or down, that will change my levels as far as like the pre-market calculations. But the nice thing is these trades can kind of sit for the week. Okay, so like I said, we'll officially start having more around that. With it's going to be a member Telegram. It should be pretty easy. I'll just throw a member Telegram in. Um, next week when we officially launch it. One second here. Okay. Waterfall today, yeah, 11:30 a.m. David. Yep, 11:30 a.m. will be live per usual. Okay. Do you want to check some crypto really? All right, let's check some Bitcoin here. Nice little run, almost 93,000. No complaints there. Okay. Also, did anybody see my post? Let's check our Daily profit play today. Did we see my post on Project Options Edge? So today's daily profit play right here. It's up a couple of bucks already. Hopefully we will see of the 70 cents. I mean, if price is looking pretty good to keep it for the entire day, I might do that. But the smart thing for me to do would be closing this thing down for like a, debit of 40 cents, 30 cents, 20 cents would be nice. Grab a quick 50 bucks on the day. So I think I'm going to look at like a 20-cent debit to close this thing out versus hanging on to it all day. But keep an eye on that one. I still have the trade pending for $1. Looking at defense trades, we might have like a quiet day overall. We'll see. Protection trades, yeah, I'll throw these in. So these are my two protection trades here. I'm just going to take a screenshot and post those in for the members. Screenshot here. So that is going in for daily profit play members. Stupid. Runny nose. All right. Broken wing, butterfly pending orders for today's VIX box top bottom using the 15.28 VIX calculation from this morning. Okay, again, that's subject to change if I see things jumping around, but those should be pretty safe for right now. Very nice. Okay, I posted this in Telegram. I went through and I created over the weekend an official trade tracker for Project Options Edge. I was tracking this on my own personal spreadsheet for the entire year that we had this bonus service. So Project Options Edge is kind of one step away from like being a full access like Diamond Club member of my my services. It's a discretionary service. A lot of the managed accounts that I look after, I trade this way where we have some capital to work with. We have a lot of income trades. I'm pretty happy with how we traded it. This is what the year looked like. We had 63 trades posted. We had 61 of those trades winners. The other two were risk defined trades. We have a couple repairs. I took some assignment on IBIT, which is a Bitcoin trade. I'm going to repair those. We've got a couple of assignments on Chipotle CMG. I'm repairing those as well, which net should be about like a $500 winner on Chipotle. Bitcoin, I'm probably going to turn it into like a $4,000 or $5,000 winner. But the nice thing is, even with the trades that we have open right now, these are, let's see, these are still open. So I've got some ratio spreads in for IWM. And then down here, we have some more open positions. Repairing Chipotle, no problem. MicroStrategy, there's a 160, 165 out to the 16th. There might be an assignment there. If there's not, there's a potential winner of $500. Then we have some open trades that are still running. And there's another like almost $4,500 in credits just on one contract with these, another $4,500 of profit that are still just open through either the end of this month or into February, or sometimes even out to, I think I did a couple that are even out to summer this year. But overall, like I said, discretionary service, 97% win rate, pretty happy with that. And this has been, issue to be like creative what we do. You can see here diagonal spreads, iron condors, 1-1-1s, ratio spreads, naked puts. It's all sorts. It's a variety of stuff. Okay, but that's it gives me the freedom to trade how I need to trade. And for those that are kind of either well equipped to follow along, have the basic foundational knowledge to trade a variety of option strategies, have some capital to work with, because I do some of these trades I play with naked puts. And a ratio spread, for example, is a naked put at the end of the day. But you don't have to take assignment on all these things. I don't want to take assignment on any of these trades, right? I'm looking for income. We can manage these trades. There's always a plan. So anyway, it was fun to go back through, what we've done and be like, oh, 61 winners out of 63 trades. That's pretty good. And the two trades we did take a loss on, it was a defined risk iron condor that I did on ES futures. and a one half of my trade that I lost on Spotify. I had a full winner on Spotify, and then the other half was a loser. So we ended up taking like I think a $900 loss, but my max risk was like 3 grand. So overall, that was, very manageable, to say the least, and things look pretty good. Okay, Mark says closed a bunch of these last week. One today on Tesla, made good money. Good. Yep, Tesla's been a juicy one with some premium. It still is. I mean, I've got a lot of trades running on Tesla. Um, for some profit, looking pretty encouraging. So Tesla is here. Tesla trading at 451. Yeah, this could get pretty interesting here. So I have shares. I have them covered. I'll continue to roll those. I also have other accounts that are pretty fresh with some modified trades. Here's a modified collar. So this one is covering 100 shares of Tesla that I'll continue to roll. The other chunk is a modified collar. You can see here this 470. Okay, 470, 450, or I'm sorry, 470, 250, 200. What I'm looking at for this trade is if Tesla is less than 470, okay, but greater than 250, this trade is, well, I guess these are puts. So 470 is where I get, I lower my cost basis. 250 is protection. So 250, 200 is protection in case things get a little wonky to the downside. But then a ratio spread, the 230 by 220, that's for $620 of income. That's out this summer. A 1111. This one I kind of like. I'm willing to own some shares. This is one I like quite a bit. $3.10. It's out to May. If we're below 440, there's a $1,000 profit trap, and if we're above 200, then there's no assignment. So if we're less than 440, but we're greater than 200, that's a $1,300 winner on Tesla. And right now, of that 310, I'm actually up some bonus profit. A lot of that is because of that 450 by 440. So could I take the profit now? Sure. I mean, it wouldn't be a terrible thing to take the profit now. I have a Tasty Trade account, 1K. Yeah. I mean, some of the like the ratio spreads, you would want to consider having some more capital, even in a margin account. I mean, I don't like the trade. I mean, you see how I look after some of my accounts. So I have stock buying power, which reflects the margin that I have to trade on. So not all these accounts are margin. I have a lot of these accounts are cash accounts. So this is, let's say, like this chunk here. I'll put blue for margin. So margin accounts. These are margin accounts. Nope. These are margin accounts. That's a margin account. Margin account. Margin. And then IRA accounts. IRA. Those are all IRAs. So what I trade when I look at my accounts is I don't ever want to trade on margin. I don't want to borrow on margin. I don't want to pay into the broker to trade on margin. So what keeps me from doing that is looking at my option buying power. As long as I always have cash available in my option buying power, that means that I still have cash available and obviously plenty of margin available. Okay. So this option buying power will never be zero and it will never be negative. All right. I want to be able to always place trades. So right now I probably am sitting around 50 to 60% cash that if I have anything unallocated, it sits in BIL or it sits in SGov. Okay. Or I can box trade it as well. But this is a good way to get about 4 to 4.25% risk free right now, which is not a terrible thing. And it's pretty liquid where within a 30-day window, you're getting about 99% to 100% of your yield. Now, again, I say 4 to 4.25. Remember, that's annualized. So all it means is if I was going to hold cash for 3 months, then take your, let's just say 4%. Take your 4% divided by 12. I'm getting 0.33% per month. So if I do that for a quarter and I'm like, look, I'm just holding a bunch of cash, I'm getting about 1% on that cash for that quarter, which isn't terrible. It's certainly better than nothing, but I can pull that out at any given time. And if I get uh, filled for plus or minus a penny or so, it's pretty liquid just to like, take the cash out, you still get your yield, and then put it into the market as you want. That makes sense. So those are some easy instruments to trade. BILS, SGOV. Those are our treasury mixes with like the 1 to 3 month, which right now have like the higher yields in the market. Okay. I'm just like I don't like bonds. I had some TLT positions. Um, I don't know. I'm a little skeptical of this whole like U.S. bonds, treasuries, risk free rate. When if it's a short term mix, okay, fine. I'd rather do a box spread in the SPX versus hold bonds. Even though the bonds last year did carve out a sliver of green. Go to so ZB is bond futures and look at the 12-month candle. Okay, so bond futures last year for the first time since 2020. 2020 bonds were up. 2021, just a horrendous bear market in bonds and has stayed like that for a while. Bonds had a drawdown of over 38%. So much for risk free, huh? So, yes, there's yields, but man, if you were investing in bonds, it's like it's been a terrible bear market for the last 4 years. So, last year, actually stabilizing, finally had an up year. So, we kind of stopped the bleeding. And with the yield on top of that, I mean, a lot of fixed income bond holders probably generated about 5 to 6% in a fixed income portfolio, which doesn't seem like much, but it seems like you just outperformed for essentially a risk free rate. It was a pretty good outperformance in bonds last year. The 60-40 portfolio, by the way, surprisingly, anybody have a guess last year? So everyone's been talking about like the 60-40 is dead, right? The 60-40, which is your equities to bonds. Okay. Everyone's been saying since 2020 that the 60-40 is dead. Look, I personally say that I don't really want to have 40% bonds. Okay. Last year, you know what it performed? It was over 13%. So last year, bonds, 13.6%. This is kind of insane. 2023, 18%. 2024, 15.5%. And 2025, 13.6%. For the traditional investing world, that's not too bad, right? And last year was the first time in a while that bonds actually acted like a safe haven. Yes, the market had a big correction in April. The markets obviously had a crazy melt up where from the bottom in April, the markets were up like 35 to 40% from that bottom, netted out about 16% for the year. If you were fully exposed in equities, you made 16% for the year in the S&P. If you did a split of having some type of offset of like protection in bonds or lower volatility, non-correlation in bonds, then you at least did 13.6. So this whole 60-40 idea is not dead. So I do argue that. However, I'm seeing some interesting changes to the 60-40, which is like a 60-20-20 or a 60-20-10-10. Okay. And that would be a mix of stocks and indexes, bonds, gold. Okay. And gold could also be gold and silver. It could be a mix of those. It could be gold, silver, and Bitcoin. It could be a mix of those. This could be stocks, bonds, gold, silver, Bitcoin. So this is what I'm seeing, kind of updated and modified to, today's market is, how much gold and silver is looking way more attractive for a holding position. Okay, good. So I just closed out my engineered options there for a 20-cent debit. Perfect. So 2 for 2 on engineered options. We'll talk about that more like when it's officially a service next week, but nice little winner. Oops. Okay. Lisa. So no, I'm talking about just general performance of 2025, like 60/40 is not dead. Okay. But I will argue that it is a lazy portfolio management style. Any financial advisor that is telling you, and look, I've had these conversations many times. The fact that I look after money for friends and family, I've had this conversation with all of them. They've all had conversations with financial advisors. Financial advisors all tell them the same thing. You have to remember, financial advisors' job is to keep you from leaving. So let's say that it's a Northwestern Mutual, it's Edward Jones, it's Raymond James, it's Fidelity, it's Charles Schwab Advisors. They're all the same. Okay, I have a lot of friends that are in the business. I get it. They get raises every single year. Think about this: for every client that they have that have buckets and buckets of portfolio mixes, for every year that the market is positive, their AUM goes up. They get a raise because their performance fee, with the tools and instruments that you're in, if overall it's a positive year for the market, their AUM goes up, they get a raise. So it's not a surprise when somebody's like, look, you know, the market itself is up 16% for the year, and my account is up 6% for the year. So when people are unhappy by that, and you're looking at like, okay, so 2023, the market's up over 20% all by itself. 2024, the market's over 20% by itself. 2025, the market's up 16% by itself. 2020, 2021, the market's up over 20% again, right? So, I mean, think about the run we've had, and everyone's talking about, well, this third or fourth year in a bull market because we're coming out of this bear correction in 2022. But look, 2020, let's just go year to date. Okay. I'll just do XSP since it's an easy way to read the index here. So just look at the last couple of years. 2020, did the year finish positive? We had, yes, a COVID drawdown, but the market finished for the year positive 15%. Yes, with volatility. Then 2021, the market was up over 26%. 2022, terrible year. Market's average drawdown was about 20%. I think the market finished like 18% down for the year. Was down about 18, 19% for the year. Most people were in a drawdown. Most 401ks were down for the year. I was not. Like active management, I was up almost 20% for the year. So despite this nasty candle, I know how to hopefully survive it and make some money. Point is, look at this outperformance. 15% and another 25%. And then you tack on 2023, 4, and 5. 23 is up 23%. 24 is up another 24%. And then 25, you're up another 16%. Right? So what does financial advisor tell you? That they're doing whatever they can to make sure that we've got some mix and it's diversified and blah, blah, blah. But I would look at the end of the day, like, what's your bottom line? Here's how I can tell a financial advisor is actively managing your money. What was your drawdown in 2022? Because if your drawdown in 2022 was greater than 10% or greater than 20%, you are way too correlated with whatever mix they have you in, way too correlated with the overall market, right? And then on the flip side of having a plus 20% year, plus 20% year, plus 16% year, if you underperformed in that stretch, you can put your financial advisor into a 5-year test to see how well they do for you, right? And kind of get a sense of, you're most likely going to take on a lot of the risk to the downside, and you're most likely going to underperform the upside. And that's every financial advisor. And the reason why is like they don't control any of the active management that goes into this. They put you in a bucket, okay, a silo, if you will, of these different instruments. And yes, they're supposed to split you up. And I guess I was trying to draw like a filter there, but that's more like looks like a jock strap. So let's put it into like a bucket. Okay. And so all we're going to do, depending on your retirement age, depends on your needs, depends on your mix or whatever, or your risk tolerance, is they're just going to park you in their instruments to spit out whatever yield they can. Right. Everybody is exposed to Mag 7. Everybody is exposed to this concentrated risk right now. This is a concern for 2026. 30 to 40% of the market is tied up in 10 stocks. If we rotate out of that, it's going to affect the overall market. It's going to, have some shakeups at the top here. All this is good. I mean, we need to have some type of rotation. This is why they're saying like the Mag 7 versus the 493 or the top 10 versus the 490. If the market is going to be healthy overall, it'd be nice to see like the 490 pick up some slack and actually start to outperform a little bit. So all I'm saying is, look, financial advisors, people have long-term relationships with them, but they will most likely you'll see very similar risk to what the overall market has given you, and you'll see probably an underperformance on the upside. And what do they do really well? They have really convincing conversations when things look bad to keep you from leaving, and then even when things look good, then they're surprised that you would be leaving and how you would ever consider using somebody else or some alternative when blah blah blah. So point is, they're all doing the same thing. Even on the institutional side, it's like I had so many conversations with financial advisors and looking at getting into their alternative asset platforms, and it just shows you like they're all doing the same thing. So what do they want? They want the market to keep going up. When the market goes down, they have a lot of conversations with you. They have some touch points, and they just try to keep you, calm, right? Market's going to be fine. We're in this for the long run, blah, blah, blah. But it is disappointing to see, and I have clients that experience this. The market's up, okay? 2020, the market's up over 50%. Over 50%. And I've had clients that have come to me with maybe 5 to 8% gains for the entire 2023, 4, and 5 window. That to me is like unacceptable, right? Market itself up over 50%, and a financial advisor has you in all these mutual funds and all these different mixes, and you've generated about 4 to 5% total in like 3 or 4 years. That's pretty bad. So anyway, just maybe 2026 is an interesting conversation to have with yourself. They're never fun because financial advisors they're not stupid, right? But they're limited to what they can do. They're not actively managing anything. What they can do is they can turn you to cash. They can limit your exposure to equities, but that would be by choice. Otherwise, they're going to try to just get the raise like they get every single year, and just keep as many clients on board as possible. Right? Steve says, agree they can't be nimble enough. Yeah, and they're never going to be. Right? They'll never hedge. Right? It's like they're just going to like dial up or dial down percentage allocations. I mean, look, there was a firm I was looking into working with the last couple of years. I still like what they do. So basically, I trade individually managed accounts. This would work out for me. They have about $2.2 billion under management, and I would be like one client of theirs. So they would come on as one client into my, friends and family advisor accounts. And they basically are responsible for like allocating. So of $2.2 billion, let's say that they allocate, $20 million to me. Well, that's great. Like that's a big injection of liquidity for me. That's a big account for me to manage. Okay, that's fine. However, it was a pay to play type scenario because I had to be in their platform to be on their list of alternative assets, that to be in their platform. It was going to cost me like $5,000 a year to do that, which is fine. But $20 million costing me $5 million a year, or I'm sorry, it costing me like $5,000 a year. But here's the reason I said no, and here's why I'm saying I like what you guys do, but I need more permissions. I need better trading strategies, because all they gave me permission to do was percentage allocation. That's it. So basically what I could do is I could say, okay, let's say they allocate $20 million to me. So my job was to say, okay, of 20 million, how do I allocate it from a percentage basis? So what dollar amount do I want to allocate to stocks, to bonds, to alternative assets, to ETFs? I can do ETF mixes. I can, dial up and dial down things. I can do inverse ETFs. I can do all sorts of stuff to get a little bit more creative, but options makes this so much easier. And so I told them after, rounds and rounds of conversations. I was like, guys, they have this great partnership with Tasty Trade. It was a private equity venture from Tasty. It was Tom Sosnoff and the team where they have their hands on a lot of stuff in the financial world. It's a good idea because basically what they're doing is they're looking for good portfolio managers like myself, and they're looking to allocate with the 2.2 billion that they have. But when all I could do was a percentage allocation, I felt like I am like a golfer that has like three clubs, and I'm expecting to go out and go win a U.S. Open. Like they don't have the tools and the strategy mix that I am accustomed to trading in order for you to manage portfolios better. So we are in like this continued conversation, these talks of like when you improve the strategy mix, when you improve the ability for me to go from a percentage allocation to actually having option strategies that I can sprinkle in around the allocations, that to me gives me more tools, more ways to diversify, more ways to trade non-correlated. That to me is a lot easier. So if they come into that with a strategy mix, great. Then I'll probably have a big client that comes in. But I just thought like it's so interesting, like how many advisors and how many portfolio managers, that's all they do is they just take a percentage and they dial it up or they dial it down. And it's just constantly just like moving things around. And that's fine. If they're active, maybe they do it every month, you know. Um, but it's limited. I don't know. So just me. I've been doing active stuff for a while, and it was a hard choice because obviously it'd be fun to have another $20 million to manage, but I feel like if I had $20 million and I underperform, I feel like the entire integrity of my track record is going to be jeopardized because I go from like last year making like 34%, 35% for the year to a percentage allocation would probably have limited me to maybe 15% for the year. So I'd underperform versus my ability to trade an options mix. So anyway, whatever. They've been taught to stay. Yeah, I know. They get it. So anyway, I'm just kind of opening your eyes. Like a lot of people have long-term relationships with financial advisors. I get it, but I've had countless conversations of, you know, this advisor at Schwab, this advisor at Raymond James, this person at Edward Jones, blah blah blah. Like they're all good at their job, but it's limited. What they can do for you, what they will do for you, they promise, and what they can actually do. It's like you will probably harm the overall market, and also still take on similar similar risk. I'm not going to say like if the market's down 50%, I would hope that your account is not down 50% with a financial advisor, but you're probably going to be down 30 or 40%. I don't think to avoid stuff like that. So, look, I don't know what 2026 is going to give us. If I'm optimistic, I would say the first half of the year is probably steady and melting up and bullish. And I think like the policy risk comes in later in the year if we have a big swing in midterms, but I don't know. Okay. Um, I really think that the markets have so many levers in place that the U.S. market especially is so like capitalized and financialized that it's like the U.S. can't really afford to have it go down. Um, the wealth effect from it would be look. I think if the stock market's really melted over or rolled over hard. I think it would put us in a recession. Even though the stock market is not supposed to be the real economy, the wealth effect it would have by the markets being down and staying down, it would. I think the stock market would cause recession. So why are we tiptoeing into 2026? Because if we don't have like perfect earnings growth again and again and again, then it just makes the market realize. And here's the screenshot I want to bring up to you. Where is my? Here it is. I thought this screenshot was pretty good. There it is. All right. Let me know if you can see this. Can you see this on the screen? Is this clear? So what this is this is the price to earnings in the S&P. Okay. Now we are sitting around 25 times earnings right now, and that is historically quite high. So 26 times earnings, 29 times earnings. What happened to my email? Let me just download the picture. All right, let me see if I can just copy and paste this. All right, that way I won't mess up my Zoom. All right, let's zoom in here. Okay, so we are sitting at 25 times earnings right now. So 25 times earnings in S&P. The big argument from the historical standpoint of price to earnings and where they've been historically. So we have the I think 17 to 18 is the historical average. So we're well above that. Okay. Um, Here's the scary part. So where we are right now, if we have any type of compression, meaning that we're at 25 times earnings, if we do not continue to keep this multiple up, where we're at 25 to 26 to 27, 28, that's the only way this market probably carries on higher is by having an increase in the price to earnings ratio. Okay. So if we are not going to continue to deliver amazing, flawless, pretty perfect earnings moving forward, reduction to 22 times earnings puts us to about 6,000 in the S&P. A reduction to the historical average, which is around 17 to 18 times earnings, puts us back down near the April lows of 2025, around 5,100. So this is what I talked about early in the year when I said the tail risk, the distribution of like where the markets could be on the downside and the upside this year is as large as I've ever seen it. Okay, because either we keep this multiple running and this market does get to 7,500 or 8,000 because earnings continue to grow. But if we have a flinch in earnings, this market will reprice things very aggressively. So I am using April lows like I did all last year. Anytime we saw a spike in volatility, I was selling premium, and project options as traders know this. I was selling premium back down to April lows. And I will literally do the same thing this year. So if the markets have, if the volatility index of the VIX goes up to 25 or goes up to 30, or we have another big volatility event, I'm going to be selling premium focused on this April low, because that would allow me to weather the storm of having some risk down here. That would be risk. I get it. Like there might be some assignments if things get really bad. It's like if we have a 40% correction, well, I'm going to be sitting around like a 35% correction, give or take. But I can repair that pretty easily. Versus I have no margin for error. All my stop losses is like I can't afford to let prices break down more than 5 or 10%. It's not the case. Like I want tons of room for error. Okay. So I think this is an important screenshot just to put in perspective how good this market has to keep performing for us to keep seeing upside. And I'm not saying that it cannot do that, because the famous saying from John Maynard Keynes is the markets can remain irrational longer than traders can remain solvent. This market does an incredible job of ignoring a lot of bad stuff and climbing the wall of worry. And it will probably continue to do that unless there is a catalyst that makes it change. And so if there is a catalyst that brings in a earnings compression, it will change quickly. Okay. But if the AI narrative is positive, if the story around our growth and our resiliency and our GDP and our consumer is still safe and spending, if the housing market is intact, it's like as long as things just can keep like humming along, markets will probably drift higher. Okay. But it is going to be harder and harder and harder to keep pushing these type of earnings gains when historically you look out 10 years and the nominal growth at 25 times earnings, okay, the nominal growth is 0%. So in real terms, the net result is 0% over 10 years. And it has been like that for over a century. So we are at some pretty scary earnings levels because it's almost like we need the market to go higher. Every analyst in the Bloomberg survey, 21 out of 21 said the market is going higher. There's a tiny bit of me that's going to be a contrarian. And it's not that I want to be bearish. It's just that I expect there to be maybe a bit more volatility than that. So we'll pull back into, previous all-time highs, maybe around 6,000, right? A run up a little bit higher, a pull back into this level, maybe a broadening pattern here at the top that we can still kind of trade. Maybe it's more of a sideways year, but it's volatile, but it still doesn't really break. But if anything is going to cause earnings to compress, I just want you to point out, I'm pointing out here, like these are big levels. A reduction to 6,000 S&P is a big drop from right now at 6,900, isn't it? A drop down to 5,000 S&P is a huge drop from 6,900. But look at a long-term trend line, and that's probably what we have to deal with. So the market can keep going higher, 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 higher. We can have a terrible correction in the market, and it's still a bull market. Okay? Keep this in perspective. And here's why I'm sharing this. This isn't to make anybody nervous. This is the reason that 2026 is going to have some cash in my portfolio. The reason I want to have some dry powder in my portfolio, because to me, there is a much bigger opportunity if we have a correction like this to add some liquidity and some capital, and participation in and around this low is a lot more lucrative to me, because eventually when we do get back to these highs, guess what? That percentage gain is far greater than the tiny little melt up that we might be seeing over the next couple of years, right? And I know Peter Lynch has a great quote. Most people have wasted more money waiting for the correction to actually get a correction. I get it. But I also know that people have made leaps and bounds. I mean, why Stanley Druckenmiller for a 30-plus year hedge fund career averaged over 30% a year? Because of dry powder and because of liquidity, at and around these lows, and exposing the market for what it is at major turning points where, everyone that it's fearful is selling, those that have money buy. So anyway, just putting it all in perspective. That's all I'm saying. Okay. So I think this chart like really stuck out to me this weekend, just kind of keeping up on my content stuff like I typically do when this is all research for me. So the good thing is 17, 18 times earnings does not necessarily break the April lows from 2025. So anytime that we get some higher volatility in 2026, let's say that we get a spike up to the VIX of 25 or 30. Well, that 25 or 30 spike to me is going to be sell some premium, use the April lows as a correction level. Ratio spreads would be great for that. Traps would be great for that, and see how low I can go to generate some income. Because the market's not going to fall most likely in a straight line. It's like it would break, and then it would make lower highs, and it would make lower highs. Like it would roll over. It'd be like, weeks of pain or months of pain. But also this may not happen for a while. So the first half of the year, maybe it runs up. Second half of the year, maybe it limps in, gives some of it back, still finishes positive for the year, but it's going to be single digits. Nobody knows, right? So the distribution of like where prices can go, they're pretty wide. I would suspect that the path of least resistance remains bullish. Okay. I think the stock market is a massive scorecard for the Trump administration. If there's one president that has bragged about the stock market, it would be President Trump. And so I think, he wants to be able to brag about how good it is and do everything we can to continue to grow. So until that narrative shifts or until the catalyst breaks it, we continue to melt up. But it's just, to me, this makes a big difference because look, historical averages are 18. And what typically happens is if we see a big catalyst that's going to start breaking earnings down, we're not just going to stop at 18 at bottom. We're going to go down to like 13, or we're going to go down to 12. And then we build the trough, and then we stabilize, and we get back to 18. So that's why the big scary stuff out there is, if we have a nasty correction, we could be talking about, 50+%, 60+%. But I don't want that to scare anybody. Look, it's not going to be fun if it happens, but I can promise one thing. If you have cash and dry powder to participate in that correction, you will make a fortune on the upside. But what's going to suck is if you are stuck at all-time highs and you're fully invested and the market goes down to those compression levels to kind of rebalance, and you're still hoping that price has to come back to this just to get to break even. You don't want to be there, right? I want to be buying as much as I can with let's say of my 100% cash position or whatever my cash position is. Let's say I allocate 50% of that here, or even 60% of that here. I still want some dry powder in case it gets worse. But at 60, 70% pullbacks, my gosh, if I was 80% invested down here or 90% invested down here, the upside is incredible. It's incredible. And it might take years to get back to it. But if you're here with an upside of, this is going to help you analyze an extra 10, 12, 15% a year, that's where a lot of wealth is generated. A lot of wealth is generated. A lot of wealth is generated. It's off of lows, So it's like we participate, we enjoy the gains, but if there's a catalyst that breaks this and pushes it back towards historical averages, you want to have some dry powder. Okay. Larry says my position negative gamma line. Mine has mostly as well. This is my real-time gamma. So 20 seems gettable today. There's very little. Yeah, my positive negative gamma also disappeared. Remember it was 55. Where's it at? 55. We're in positive gamma today. Here's real-time Gex. So, stickiest levels. We're getting some positive gamma flows. 69, 69.05, 10. That's all good stuff. Yep. We'll see where the day takes us. So plus or minus on the day, we're up to 13. We opened up around 91, so it's already up about 22 points out of a plus minus 30. So hopefully we don't go much higher than 69.20. And not bad. Okay. Good stuff. Does that screenshot help? So if we, catalyst, I don't know what it is. I think that there's probably more things stacked to the upside and the downside. What would be the big earnings compression? It's got to be some type of ugly AI story. Hey, everybody in my 7 is, asking for $10 trillion in debt in order to finance build-outs. Questionable because you're not going to get the ROI. Maybe that's enough to break the narrative. One thing that could be out there that we've talked about, it's a bit of a black swan, but it has to be on the radar, would be any type of war efforts or conflict efforts that things escalate between U.S. and China, China, Taiwan. Like that has to be a major like tipping point for the market. Any threat of like world number 1, world number 2, and some type of conflict, which again, I don't think either one of them want to do it, but it's got to be on the radar somewhere. I just think that a black swan is a black swan for a reason. I didn't think that COVID in 2020 would be the reason that we dropped 35 to 40%. But it did, and it did it over a 30 to 60 day window. But same thing last year. It's like we had a 20% drop with a trade war that reflexively we came out of it with a huge upside. So anyway, I think right now it's like we won't disrupt the current trend. We won't disrupt this melt up. The narrative remains intact. There's growth. We're looking at optimism, blah, blah, blah. But I would say from a price perspective, a little sideways here to me would be better to keep this thing running versus just making highs and highs and highs and highs and highs. I don't love that look to the chart. Obviously, it could happen. But if that structure breaks, my concern is that we come out to a bigger trend line out here. And when it rolls over, we look at a big pullback from trend line to trend line. A lot of traders will be losing in that environment where I'm just like, all right, just let me find some levels to buy at a really nice discount. Got to be patient. So anyway, fun for the day. Okay. So we are above all gamma levels, 69.20 based on the market maker move. Hopefully is going to stay, prices should hopefully stay below 69.20 today because that would be the plus minus move on the day. So if we kind of, run up, stall out, markets are up about 0.78%. most of it was in the gap. So gap from close last week to the open, that was a gap of almost 0.5%. So we'll see where the markets end up finishing on the day. All right. How can I kind of recap in here for the day? Yeah, I see that. I see that, Blake. Okay. Let's check on daily profit play. Daily profit play up a few bucks. That high is 69.30. So I'd like to see if price can stay below that today. I might try to pull as much out of this 70 cents as I can. Even grabbing the full 70 cents at expiration today would be fine. We'd have to fall all the way back into the gap fill. So my 68.40, we'd have to fall all the way back down here to fill the gap and then fall lower. Probability wise, it's very, very low. What I'd like to see is that price doesn't go too much higher than now. So if we stall around 10, that's fine. If we, obviously hit a wall around 20, 69.20, I want to see prices kind of settle back in line. So if my 70 cents is trading for, I don't know, if it's trading for like 30 cents or trading for 20 cents, I'll probably just take the profit and hopefully grab, 50 cents out of it today. If I can grab 50 cents profit out of that 70, I'd be pretty happy with that. Okay. There's this big rotation. My dividend stocks are getting hit pretty big. Yeah, I don't know, man. I don't think a 1 day thing makes a trend. I think that there's going to be a pretty solid rotation this year. I would think there has to be. So keep an eye on RSP. I mean, RSP's up, right? But we haven't hit alerts yet. Let's go to market breadth for a moment. Here's how many stocks above the 50-day moving average. Okay. So we were at 60, almost 65% of stocks above the 50-day moving average. Let me set a chart alarm here and see if this gets crossed. I mean, a good sign of market breadth is that we just continue to kind of make higher highs in market breadth, which means the percentage of stocks above the 50-day average continues to climb. How many stocks above the 200-day? We're at 58%. So we've retreated a little bit, but still, like 55 to 60% of stocks are above the 50 and the 200-day moving average. The Nasdaq, look at this rotation. This is the rotation that I'm seeing right now. A rotation out of growth, out of momentum, out of tech into other stuff. This to me is like the most notable rotation that we've been watching for the last like 30 days. I mean, we're down to 41.5% of Nasdaq stocks. If there's one index I don't really want to touch much this year, it's Qs. Like the Nasdaq to me is the most vulnerable because if money seems like it could be treated better elsewhere with less risk and more stability and more upside, it would be treated better by getting out of tech and getting out of momentum and growth and going into some more stable stuff. And honestly, the price appreciation could still be solid. It's just, I mean, could we have price appreciation of like the financial sector, the utility sector, the materials sector, right? So I'm really I'm a bit skeptical on the Nasdaq. I get that we're a service and tech based economy, but valuations run really really hot, and the narrative is like how many companies in the Nasdaq are truly making a lot of money outside the Mag 7. So I'm skeptical. How many companies in the Russell 2000 are actually making money? From what my research shows, it's like 60+% of Russell companies making profits. So they need to see the markets getting rate cuts. And I also have my reservations about how many times the Fed's going to this year. The market's expecting 2 more cuts in 2026. That's a big if. And I think that's an if inflation goes down, the Fed will proceed to cut rates. If inflation is sticky, the Fed is not going to be cutting like we think. Even though we're getting a new Fed chair, there's still a whole council, right? That whole academic council of the Fed members. They can dissent and they can argue, and every month it could be Fed drama. But ultimately, if they don't cut, market's going to have a reaction to that. If they do cut, market's going to have a reaction to that. So I'm sure it's just like it was last year. Every month, every FOMC, every rate decision, it's going to be big news. You kind of wait and see how it all plays out afterwards, right? Which is annoying. But inflation is really the thing to watch. I will keep an eye on this. So while we're waiting for our US data to come in, here's an easy website to just keep an eye on. I'll check this, on the regular. We are seeing lower inflation. So this to me is like a little bit more trustworthy than headline CPI, because this is already getting composition. Look, this is everything: groceries, housing, transport, utilities, healthcare, household items, alcohol, tobacco, clothing, communications. Look, shelter is like 40% of the US CPI, and they say that it's lagging. So this is what makes it up. Okay. But when you look at the index, this is what I've enjoyed seeing the last like 30 days. It is trending lower. If I see this trending lower, we are going to sit on these major CPI prints every month. I would expect the trend to reflect that. So we had a headline print of 2.7, and it was this big celebratory print, but also because you know what they did for October? During the government shutdown, they basically said that inflation is 0. So it messed up the averages, which is crazy that it's like, really, you could just do that for government data? You're like, well, we don't have it, so we're just going to put it in as we're just going to skip it. But they marked it as 0. So that's why we went from like a 3% inflation print to down to 2.7. But in a real time, like inflation measured data point, if we are trending lower, I'm expecting the CPI, even though it's lagging, I expect the CPI to also trend lower. This is also why when we went from 2.3 CPI up to 3% CPI, it didn't surprise me that we were trending higher. So this is encouraging that if this continues to head lower, then our 2.7 should hopefully continue to go down, maybe to 2.5, maybe to 2.3. Heck, maybe we get to 2%. What's going to be interesting is how many people celebrate 2% when it's like, guess what? Prices are still expensive. Prices of everything are still going up by 2% a year. I mean, even if we had 0% inflation, our prices aren't getting cheaper. It just supposedly means that prices will be not going up. But we have to have 0% inflation in order for prices to not go higher. So, I mean, I'm not going to celebrate 2% inflation. Like, it's better than having 4%, 5%. But if you go too low on inflation, we're going to choke out growth. This is why we're like such a weird environment where it's like the market needs some inflation to grow. And the Fed, I don't know. I think after the cutting, it's like inflation goes lower, they'll probably cut. They'll probably cut 1 or 2 more times this year for another 25 to 50 basis points. It may not change the 10-year much at all. We've still got chart alarm set in the 10-year. The 10-year is at 4.16. It is still higher by 50 basis points, right? I mean, imagine this. For the last 2 years, everything as far as borrowing costs, it's about 0.5% higher. You want to buy a car, it's 0.5% higher, probably more. You want to buy a house, it's 0.5% higher, probably more, because you have the markups of the lenders as well. So this to me is, if things are going to get better, this 10-year has to go down and break 4. If we get a sub 4, if we get a sub 3.6, we might see 10-year yields changing enough that maybe the 30-year fixed mortgage, we might see a refi window that looks a little bit more encouraging. I'm in that camp. I closed this house for 6.62, which I freaking hated. My last mortgage was 2.72, right? So now I'm at 6.62 with a new house. So I want this to be down. If I can get this thing down to 5, 6 or lower, great. Pays for itself in 12 months. It's justifiable. And, it changes we'll probably see like $400 to $500 off our mortgage price. but I don't know if that's going to happen this year. Yep. Yeah. I mean, that's the difference is if you refi in the house you have, greatest thing ever. Anything through 2021, 2020, 2021, if you refied or you bought a new house in that window, um, best rates ever. And I don't know if we're ever going to get back to that. I really don't. We'd have to have like probably something terrible happen for our rates to get down sub 3% again. So I think that we are in a new normal of probably having like, if we're lucky, low fives, but probably in like the 6+% rates. So, we'll see. But yeah, I mean, if I could refi at like mid fives or low fives, like I'd lock that in and be pretty happy with it because it's all within budget. It would just be nice to not feel like you're paying X amount for interest. Scott says, "What's a gamma indicator?" Yep. So I trying to think. I've done some lessons on it, Scott. We spent a lot of time on it last week in the daily profit plan. I'm trying to think what session it was. But Blake, you remember? I don't know if you were with me last week. Maybe on Friday last week, I spent some time on it. I know one of the daily profit plan sessions we did. I spent some time on this indicator and showing this. This is a live dashboard as well. And I have this is software that I subscribe to that I because I am in kind of the public space, I'm an affiliate for them. But most of that is just because like I use it every day. This software I've had for the last 6 years, I use this stuff literally every day. So anyway, if you want to send me an email, Scott, Chris Pulver Pub at gmail.com, post that in the chat right now. I'll send you the links if you're interested in checking out. There's plenty of education, and I'm also happy to have some like if you want to do like a one-on-one session, I'm happy to help you kind of use it, get it set up, and what I do with the best practices wise. Cool. Okay. Good stuff. All right. So for the first full trading week of the year, let me spot check some data points. Any questions? We covered a lot of stuff today. We covered, earnings where we're at 25 times earnings. It's historically high. Capital ratio at 40 plus. It doesn't mean that we can't go higher, right? In fact, that's probably what's going to happen is we'll probably just go higher. But we are in the U.S. here. We are pretty priced to perfection. And I just think it's going to be very difficult to keep justifying these earnings gains over the next 5 or 10 years. So I would just expect there to be some turbulence and volatility along the way. I'm just putting into perspective, like if we come down to normal earnings averages, that's a big correction. We're talking about, from current prices coming back down towards April lows. That's a 30+% correction. Like I said, when we usually see these big compressions, it typically overshoots to the downside, and that 14 or that what's supposed to be averaging around 17, 18 could easily slip down to like 15, 14, 13, and that could get us into like that 50% correction, which would be terrible, right? And honestly, a lot of retail traders don't typically survive that stuff. I'm here to tell you that you have to be able to survive that stuff. Right. And the only way you can do that is by never being all in on anything. All the trades and services I'm running, they're income trades. It's less than 1%. Have dry powder. There are bigger opportunities ahead with pullbacks. Yes, the market can melt up, and that's fine. But a melt up of, let's say the market can go up to 8,000. Okay, let's say the market can get to 8,000. You know what I'd like to do for every dip? Add some exposure. And even if the market dips like this and I add a put that is down here and it pays me, and the market goes up again and then it pulls back, and I add another put down here and it pays me, and the market goes up again and then it's like anytime I'm getting like pullbacks and I'm adding premium down here, it's like I'm using April as a line in the sand last year. And if I can generate income along the way, fine. I can still generate profits on the way up to 7,500, 8,000 without having full equity exposure of like, if the market tips over, I don't want the drawdown to feel like for every percent that the S&P is down, my portfolio is down right alongside of it. I don't mind tolerating risk down here, but if the probability of getting there is like less than 1%, I just want to stack up a bunch of income trades, within reason, obviously. But I could take assignment on one of these trades and then close the other ones out with manageable stop losses. But like I said, I would part of me like part of me wants a correction so badly in the market, but I'm not going to trade for it, right? Like I shared this with Crash Insurance. I mean, we're doing a butterfly spread that pins us at like a 20% correction. So if we get anything in like the 10 to 15%, obviously 20% is perfect. But if we get anything like that 10, 15, 20%, we're going to see some good reward to risk on that trade. And then the upside, I have a 9-1. Okay, or maybe it's closer to like I think it's 9-1. 9-1 at an 11% drift. That's not Crash Insurance. That is just trading a low reward, high risk setup. If the market can find a way to drift up to, 10% higher this year, 11% higher this year, maybe overshoot to 15% and then fall back down, there's a good reward to risk. So for a total of like $1,500 in risk, I have up to, like 25K to the downside and up to about 10K to the upside on $1,500 of risk. And a price stays in the middle, well, guess what? I'm risking $1,500, less than 1% of my account. So lots and lots of ways to do this stuff. Let's see. A join your VIP club seems too fast, too many open positions. Yeah, Sheik, I swear you asked that. You said you joined the VIP stuff. So what was the VIP club you joined? Did you join my all access? What'd you join? Lifetime of what? Like every service has lifetime. Every service has lifetime. Every service has lifetime. Waterfall. Okay. Well, that's very different. All you have to focus on is waterfall income. So this session that I'm running right now is touching on daily profit play. I've got waterfall income coming up in the next 30 minutes. Double ups will start to heat back up, but now that we have full weeks of trading, like the holidays are done, it's officially time to start trading. Okay, so the last couple of weeks of like I'm a little bit cautious, not sure what the market's going to do, inefficiency, low liquidity, low volume. That's done. We've got news this week. It's back in the saddle. It's time to trade. Okay, newsbreakers. Once we have earnings season kicking off, we'll be active in earnings. So to your point, Sheik, all you have to focus on is waterfall income. This service, this daily session that's free for everybody, it gives me the freedom to talk about whatever I want. So these are all the things that I run. Okay. So I touch upon them because they're all live trades. So I'm like, yeah, I've got, engineered options running for this week. I've got daily profit play for today. We got waterfall income. We'll have all sorts of stuff that I have to touch on. So it's not too fast when you come into class at 11:30 because waterfall income is just a class, live trading session, and it's a couple strategies to review. So you'll be fine. Okay. All right. On that note, let's go to this week. I'll just make a couple of housekeeping items here. So daily profit play. Daily profit play. Live sessions Monday through Friday. We're back for hopefully normal trading for the week, which is good. Waterfall income. Live trading session. Excuse me. 11:30 a.m. today. So in the next 35 minutes, we'll be live for class. Double ups. Let's see what type of weekly flows we get. Pinch point. We got some live trades already running. We've got like swing trades and expirations. Engineered options is new service. January 11th is the official launch. Okay. So that's going to be a Sunday night webinar. Lance and myself will be doing it, and then we'll be probably playing some encores, or I'll be doing it live all next week. I'm excited about it. It is a like pre-market Monday, post-market Friday. It's a members telegram, set it and forget it trades, define risk. You can trade for as little as like $50 risk a week. You can scale it up to thousands or whatever you're comfortable with, but it's all about percentages and it's about keeping an edge in the market. And also it's about good reward to risk. I want to make, one-to-ones. I want to set my levels where my, reward to risk is going to be manageable, where it's like my winners net should take care of, like my winners should be bigger. I want bigger winners. I want, a win percentage of 65, 70+%. And I want winners that are equal or bigger. It's a lot easier to make money. Also, that's an easy way to kind of rotate into for the year. If I'm a little bit cautious, but yet the market's going to keep melting up, it's a great way to pack away some nice income and also never be overexposed and taking, any inevitable losses we do take. It's a lot easier to know, like, if I'm making, $100 on a winner and I'm losing $100, well, all I have to do is win, 51% of my trades. I'm making money, but we're going to win closer to like 65 or 7%. We'll be fine. Okay. All right. Crash insurance. I posted a little, 26 to 1, 30 to 1. We looked at SPX as well. So this one, I took a trade on ES. This was last week. So ES butterfly. And we looked at an SPX butterfly. That was like 35 to 1. So those are some pretty cheap trades to post. I put that in the crash insurance alerts. Project options edge. So this is kind of a bonus discretionary service. And I have an official tracker now. We're 61 winners and 2 losers through 2025. Overall, very happy with that performance, and that helped get me to the gains that I had for the year. A lot of that was steady services here, but then the way I manage some accounts and go for higher probability. It's a variety of option strategies, so it's probably like the more educational intensive one. But as far as like following alerts, if you're comfortable placing those trades, you've got some dry powder and some capital to work with. I mean, it's how I trade. So anyway, lots of ways to get it done, everybody. That's for sure. We'll do our best. So, all right, I'll wrap it up there for today. Waterfall income, I will see you in about 30 minutes. Let's keep an eye on the day. I need price to stay below 69.30. Okay, below 69.30 for today's. Hopefully, we're not going to go above 30 today. I'll set a chart alarm just to be safe. There's 69.30. So it'd be nice to see just kind of, we're drifting, but stay below 30 today would be great. Or we kind of settle back into 69.05 or 6900. If you took that bonus trade with me, that bonus trade is now in profit. So if you wanted to grab, the $2 credit, it's probably trading for 50 cents, 60 cents debit. If you want to close it out now, we needed price. I mean, right now it's technically in that trap zone. So that 69.15 to 69.05, that is a trap zone. 69.05 is $1,000 trap. I mean, it's only 11 a.m., so I don't know how much it's going to offer, but it's got to be offering some type of bonus profit right now. So fifth, it was the 69.15, 05, and 90. So I feel like this is offering. Is anybody still in this trade, by the way? Who's still in that bonus trade where we did that broken wing butterfly? It was a $2 credit fill. Because I think that right now it's probably offering some credit. Like you took the trade in for a credit, it's probably able to close for a credit right now. If you're not in it, no big deal. I'm just curious if anybody has it running. Because if we are at 60, change the color here. If we're at 6,900, that is a $5 trap plus the $2 credit. If you're at 69.05, that's a $10 trap plus the $2 credit. If we're at 69.15, there's no trap. If it's greater than 69.15, you still get to keep the full $2 credit. Okay. Still in it? Good. Okay. So Snapper, will you look and see if you're trying to close the trade out now, is it trading for a credit to close it? So the $2 credit entry, is it offering a credit to close the trade? Because that's a bonus. That's a bonus trap right now. Even though it's not full profit by the end of the day, look, if we close it at 6,900, you're up $500 plus the extra $2. If we close around 69.05 today, you're up $10, so $1,000 plus the $2. If you're greater than 69.15, you're just going to keep the full $2, and it will close for $0. Right? Your $2 credit expires at $0, so you're keeping the full $2. So it's offering a credit right now. Okay, good. Yeah, so that's good. And again, I mean, there's no harm in obviously protecting the profit. So we could get extremely lucky on the trade, and let it sit longer, and then that butterfly, it's a broken wing butterfly, so the trade looks like this. If price falls, you have your bonus profit, and then you have your risk. So there's your $2. and that is the 69.05. And there's the profit trap that starts at 69.15. So if we're hanging out around, we're oh 07 right now, it's like oh 05 is like the perfect profit trap. But the reality is this is what it's going to look like today. It's probably looking something like this on the real P&L, is it might be like this. Just a little tiny profit trap right now. But if you get in for $2 credit, you can close it for 50 cents credit, 75 cents credit. You're making extra profit on the trade, which obviously is not bad. Okay. So anyway, good stuff. All right. I'll let you go for today. Waterfall income students, I'll see you in about 30 minutes, and stay tuned for more this week. Hopefully we carve out a winner for daily profit play today. I'll post that in the alert section. We'll see where prices settle, and let's talk again later. All right. I should be live today with Lance around 1:30 p.m. Getting ready for engineered options coming next week. That service officially goes live. I'm just going to be updating my like deck and levels every single week. So we'll do that this week. We'll do it today. Get a couple trades in. Okay. Talk soon, everybody. Bye.
All right, ladies and gentlemen, we're going to hang it up. Have a great night, folks. We'll see you guys. I said night. Have a great morning. We'll see